Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Welcome back to Investing Month. Today we're going to talk about what you can invest in and how you can do it.
Yes, good energy, Kate. I like it. So we're in episode 2 of the Investing Month, where we'll take you through investing from beginning to getting started. And if you've already started, you'll still enjoy it because we cover a lot of interesting ground, including in today's episode where we talk about all the different things that you could invest in. Maybe there's a bit of an asterisk there because we probably don't have time in 20 minutes to cover every single thing, but we'll give you a broad idea of all the things that are available. Yeah. And there's a lot.
Probably the investments that are most relevant to newer investors and keeping it useful and actionable. And then for some of these types of investments, we'll have individual episodes throughout the month on them too. So you can learn much more about them in detail.
So you can learn more. And if even in those episodes where you do learn more about the things we're about to talk about, there's even other episodes or series that you can dig further and further down. And that's the whole point of the podcast series.
There's a lot of layers here.
So what is your investing universe is a good question to start with. It's like, what is everything that's available? So we use the word universe because there are so many things out there. Some things we don't understand, some things we do. And then we try and break that down into groups. We sometimes call them asset classes. So we basically say, you're like this, and you're like this, and you're like this. And that reflects basically how the world is set out financially, like the financial system, economics, what we're taught at schools, etc. So, Kate, where do we start?
Yeah. So the very first thing that most of us are familiar with is cash.
Yes. Okay.
So we might have it under the bed. Yep. We might have it in a transaction account that we're paying for things on a daily basis. We might have it in a savings account working towards a holiday. We also might have used a term deposit before.
Yeah, it's known as a TD overseas. Yep.
But we can also have cash as part of our investment portfolio, and it can form part of our investment universe.
Yeah. So one thing that I was always confused about when I first started learning about finance was people said cash. And you would think that, like, so they'd say cash in a portfolio, and you'd be like, cash, like, as in, like, there's like $50 notes just like there. And that's not what we mean. What we mean when we say cash, it's cash, like, as in stored at the bank, cash in a term deposit. There are even cash ETFs, and we'll get to that in a second. But cash is anything that's basically maybe not always guaranteed, but kind of stable, and it just pays you interest. It doesn't really fluctuate in price, like the value of the cash in the term deposit doesn't fall one day and then go up the next. It kind of stays stable. And that's what we mean. So we'll come back to that.
Yeah. And we mentioned investment income in episode 1. So you usually do get some form of income from the cash.
Yeah. A lot of people, when they think about cash, they don't think of it as an investment. They kind of keep it as like what we call like a ballast, like it's like protection in a portfolio. So it's there so that in the future you can use it. And that's where the value really comes from for cash, which is different to what you have in your savings account or your transaction account where you can spend it. Another thing, and this is the thing, we're going to go from the easiest thing to one of the harder things to understand, which is this idea of something called bonds. Now, bonds are just an IOU. So like me giving you $100, Kate, and you promising to repay it, right? And that is what a bond is. My word is my bond. That's where it comes from. And the biggest thing about bonds is that there are many different types, just like shares, which we'll explain in a second. But they're typically lower risk when they're government bonds. So governments right around the world use these. They go and they say, we've got some bonds available, investors go and buy them. And then the government promises to repay the money that,
possibly in 10 years' time.
10 years' time is most common. And they pay it back with interest. And bonds form part of most people's portfolios if they see a financial advisor.
In many
superannuation funds, in most professionally managed funds have bonds in them because they again, they're more of like a safety mechanism. So yes, they pay a little bit of interest and their price can fluctuate a little bit, they're not as stable as cash, a little bit more unstable, but they give a little bit more income for that risk. And in retirement portfolios, there can be a lot of these. The next thing, Kate, is gold.
Yes. So many of us would be familiar with gold. We might have some gold jewelry.
Yeah, something like that. They even are on the end
I don't
of
know
drill
why
bits.
a gold tooth popped into my head. I
Some
don't think
people
many
have
of us would have a
Some
gold
people
tooth.
have gold caps on their teeth, right?
Yeah. So
But-
you can physically buy gold and hold that. You might have a block of gold in your
Yeah.
safe at
A
home.
lot of people do. Yeah.
Maybe your grandparents have some gold. You can buy it through a digital platform. So there's ways you can buy and sell and pay with gold nowadays.
Yep. there is.
Or you can buy it through an exchange traded fund, which we'll discuss a little bit later in this episode.
So gold has been around for a long time. There's the idea of the gold standard, which was our currency as a global economy. We used to use gold. And then we moved to actual currencies issued by governments. And today you can still send and receive money, and it can sometimes be settled by gold in vaults around the world. But for the most part, gold doesn't pay an income. So it doesn't pay you a dividend. It doesn't pay you rent. So some people consider that it's not an investment. It's more speculative, meaning that you're really just betting on the price going up or down. So needless to say, it can still form part of a portfolio. The next thing, and this is probably the thing that people are really interested in, Kate, is the shares that go into a portfolio, sometimes called stocks and sometimes called equities.
Yeah.
So can you explain those?
Part ownership of a business. So think of your coffee shop around the corner. It might have two people that went into business together and they might both own a share in the company. So they might both own 50%. There's two shares, two shareholders. So when you purchase a share, you're a shareholder of that business. So think of large Australian businesses like BHP or Telstra or Commonwealth Bank. You can actually purchase shares of these companies because they're what's known as publicly listed companies. So they're available to purchase on our Australian stock exchange. So at any day during the week, you can buy and you can sell shares in these businesses.
Yep. So between 10 a.m. and 4 p.m. Eastern time, the stock market is open.
Monday to Friday.
Yep. And these companies are available for you to invest in them. So obviously you can get a sense that the cafe in your local town is very different to Commonwealth Bank. So if you put, $1,000 into Commonwealth Bank, you're probably going to be a tiny little shareholder in this gigantic thing and you won't have any control over it.
Yeah.
But let's say you put $1,000 in a new business idea, you might get 50% with your friend, right? It might not be the cafe yet, but it might be the idea of the cafe. Well, you might be able to control what that business does. But on the stock market, you can't control it. So that's kind of the
many
difference.
of these companies have millions of shareholders. So Owen and I might own a large Australian business, but there might also be millions of other Australians that own this business. So if we want to change the product, we don't have much of a say.
Yeah, exactly. So to buy shares, you need a broker, which we'll cover in a future episode. A broker is kind of like, it's like if you have never experienced one, the easiest way to think about it is like Amazon mixed with your online banking. You can fund the account, you can look through the marketplace or the stock market to find the shares that you want. You click buy, the transaction happens in the background.
Yeah. It saves me having to hunt around for someone who has the shares that I want to buy. This all happens automatically in the background and often within seconds.
Yeah. The next thing that people can invest in is property. So property can be your primary home where you live, or it can be an investment or multiple investments. Some people buy apartments for income. Some people buy houses for long-term growth. There's obviously different price tags. And there are many different costs that come with these. We do have the Australian Property Podcast, which you can go and check out. That's our free podcast that focuses only on property. But there are many different ways to also invest in property outside of like a residential home, Kate. You can use REITs.
Yep. Real estate investment trusts are one way you can buy and invest in property and infrastructure through your brokerage account. So the same account that you can buy shares, you can also buy investments in property.
Yeah. So these are called real estate investment trusts because they've just got real estate and they're held in a trust and you can buy part of the trust.
Yeah.
Just like the big buildings that you see. So these are not like little houses. These are like the gigantic buildings that you see in the cities or the massive warehouses that fulfill Amazon orders, those types of things. Maybe you mentioned something called infrastructure, Kate. Not to confuse anyone anymore, but this is the final piece of the puzzle. This is what we call an alternative investment. So an alternative investment is basically anything that doesn't fit into the boxes or the categories that we just mentioned. So cash, bonds, gold, shares, and property. Alternative assets are this label in the finance industry that we give to make sure people understand that what you're investing in isn't like those other ones. It might look similar, but it's still quite different. For example, you might have a type of property, say like Melbourne Airport, right, which is a gigantic airport in Australia, that might not be available to be bought and sold on the stock market like a share. It's a private thing. So the only way to get into it is through a different type of entry point. And that would be alternative, right? So we call that an alternative investment. Other things are like you mentioned, like some roads and that sort of stuff are if you want to invest in those roads and receive that. The other things like we've got collectibles, different types of strategies can also be alternative. They might do the same thing, but they do it in a different way. So for example, you and I go and buy shares, it goes up over the long term, but you've probably seen those movies where people will bet against shares. So they would be called like a hedge fund. Well, that's an alternative investment because it doesn't do the thing that's normal.
Yeah, and often they're a little bit trickier for investors to get their head around, to get started with. They might require a bit more money to invest in these things, and they might be a little more stagnant. So they might be harder for you to buy and then to sell them. Like if you think about a big office block, a company can't just sell that the next day. They often it will take months or years to sell that.
Interestingly, like cryptocurrencies would be an example of things that fit in alternative because they don't have like the true history yet. Some of them do, right? Obviously, Bitcoin's gone back a bit, but it's still not generally accepted as a stable kind of asset class yet. So the question is, so we know all these things that we could invest in. Most people will be familiar with shares and property and cash, but the interesting thing is how do you invest in them? And I was hoping to make a distinction with this because people can invest in these things in different ways. And we'll go into depth throughout the series, but you mentioned something called an ETF, Kate. We have a mini-series on ETFs, a separate mini-series, and we talk about them every single week on all of the Rask podcasts. But what is an ETF?
Yeah. So an exchange-traded fund, an ETF, is a basket of investments. So it might include shares that we mentioned earlier today. So you might have a basket of the top 200 Australian companies, including names like Telstra and BHP and Commonwealth Bank and Wesfarmers. And an ETF manager will collect up all those companies, assemble it together in a fund, and I can buy and sell units in that fund. And the fund often follows a set of rules or common characteristics.
Yep. So an ETF would make it easier because instead of having to pick which stocks go up or which bonds are good, you just buy a bit of all of them.
Yeah.
For the most part. Some ETFs are a little bit different, but the most popular ETFs in Australia are the ones that just buy the top 300 shares in Australia, the 300 biggest, or they just buy the top 500 in the US, the biggest 500. And that's all they do. They just go out, you put your money in, and then whoever runs the ETF goes and buys those 500 or those 300, collects them for you and says, here's your ETF. You've got one piece of this ETF, which we call a unit. You've got one unit of this ETF and saves you having to buy 500 different shares.
Yeah, because there are so many different companies to choose from. Using someone that packages it up for you can often make it easier to take that first step as an investor because, as we'll discuss in this series, it's a lot of work if you want to buy an individual company. How do you know if that individual company is going to be better than all of the other competitors out there long term?
Yeah. So there are different types of ETFs. And there's the ones that we just mentioned, which are those kind of like boring ones. We call them index fund ETFs. But then there are more exciting ones, which are what we call thematic. So this is like, I believe in the future of this industry and
robotics,
cybersecurity, artificial intelligence, agriculture.
And they would bundle up companies in that industry and put them in a basket for you. And so you could suddenly be invested in 30 robotics companies with one purchase.
Yep. And they don't have to just be shares, as we've mentioned. They could be bonds. It could be, you can even get cash ETFs. So if you want to invest alongside other investors, the ETF can then go to a bank and with all of the money included, try and negotiate with that bank for a better rate. And so that's a cash ETF. And there are so many different things. Another thing that is very similar but different is called a managed fund. A managed fund is just like an ETF, except you can't buy it through your brokerage account very easily. So an ETF, use your share broking account. It's the same thing. You can buy Telstra right beside an ETF. But with a managed fund, you can't do that. A managed fund is more the older style of investing, but it's still very popular and still, I believe, the most popular.
Yeah, and you have to fill in an application generally, and often the investment amount you have to start with will be higher. So it might be $5,000 or $25,000, whereas if you're buying shares or ETFs, you can start anywhere from $500 to $500, depending on which platform you go with. So we'll cover that later in this series. And the fund manager could choose to invest in different things. And they'll say that on the website, so you know before you go in what type of things they're choosing to invest in. They might choose to invest in small Australian companies. They might choose to invest in property. They could choose to invest in bonds and other alternative assets that we mentioned.
Yeah. So these things, managed funds, sometimes they get a bad rap. Sometimes they're really good. But they often do different things to an ETF. They're not always the same. But a good example of this, if you've ever heard the name Vanguard do both managed funds and ETFs. So people sometimes think they just do ETFs, but their managed funds are much bigger than their ETFs. Other names might include BetaShares, GlobalX, which is a sponsor of this show, and so many others. And they're both the same thing, really, for most of them. It's just a different way to access what you're investing in. And finally, we've got super. Yes. So superannuation is the same thing. People think that they're not investing, but they are if they get superannuation.
Yeah, and often when we run events, Owen, a lot of people say they've never invested before, but when we ask people to put their hands up if they have a superannuation account or multiple, given many of us had part-time jobs growing up and in uni, everyone puts their hands up. So that means that you are already an investor. You're investing in things like shares and bonds and property through your superannuation company.
So if you're invested in super, you're an investor. The only difference is with super, well, the major difference is that you can't get your money away out of it until you're retired or you die. Unfortunately, then it's not really going to you, it's going to your next of kin or whoever you appoint.
And their team of experts builds a portfolio for you. So you might say, I want to invest in higher risk investments because I'm going to not need this money for 4 decades. And they will build a portfolio that includes things like shares in Australia and overseas. It'll include property and infrastructure. It'll include bonds. Maybe it includes gold.
Yeah. So the basic gist is, and you touched on something really important that we will just kind of put a ribbon on this episode. Some of the things that we mentioned here are considered riskier and some of them are considered less risky. But they all tend to fluctuate a little bit, maybe with the exception of cash. So say, for example, cash and bonds from government bonds, they're considered to be safer style investments, meaning that there's not as much ups and down. Gold is also considered to be sometimes safer, but sometimes not. It does go up and down.
And you might see the word defensive used to describe these type of investments.
Exactly. So the next thing on the other side of the table, we have shares and property. These are both considered to be riskier assets.
And growth.
Yeah, and growth. And within those, even within those categories, there'll be much riskier shares and there'll be less riskier shares. There'll be much riskier property and there'll be less risky property. And so all of these things combined, we can build a portfolio that takes more risk, typically, for someone that's got a long time horizon because they've got more time to recover and more time to grow, or shorter time periods, like more like retirees and people late in retirement, they have more defensive assets because they want more income and they can't afford to lose money. So that's all taken into account typically when a super fund builds a portfolio for you. Yeah,
so ETFs, managed funds and super, the risk of those investment products really depends on what's inside that basket or fund.
Yeah, so that's a great point again, Kate. So these things, it all just depends on what you're invested in. So ETF is just a way to get through to other types of investments. A managed fund is just a way to get through to other types of investments. It's typically run by a professional investor. Superannuation fund is just invested in something else. So you've got to really pop the hood to see what's inside to determine if it's a good investment or not. Whereas a lot of people just go, I invest in ETFs. Oh, I invest in super. Well, what's actually in it?
Yeah, and that's what matters. It's what's inside ETFs, managed funds and super, because you could put just cash in your ETF or your super fund, or you could have some higher risk investments. So that will change the time that you want to be invested for.
Yeah, it's like a box of chocolates. We've used that analogy before, but what's the chocolate inside? Don't blame the box. Like what's actually inside of it is what's important.
And that's how you'll start to work out if it's right for you. And as we go through the series and talk about different things, that's worth keeping in mind.
Absolutely, it is. So in this episode, we've talked about cash, bonds, gold, shares, property, alternative assets, whatever those are. There's a lot that we've covered just in that piece.
Yep.
And then we've talked about ETFs, managed funds and super, the how do you get invested in those. We mentioned the thing called a brokerage account. We're going to do separate episodes of these. So if you're overwhelmed, it's okay. You're not alone. There will be more separate episodes on these major ones. So we're going to cover shares.
We're also going to cover cash, what that looks like for investors. We're going to cover the vehicle we talked about, exchange traded funds, and how to research different types of exchange traded funds. We're also going to talk about managed funds, which is something a little less commonly discussed, but worth our time and attention.
Yeah, because a lot of our more seasoned listeners will be familiar with us talking about ETFs, but not as familiar with us talking about managed funds, which is a huge part of what we are interested in. And we think as investors go on, they get more interested in these things, because they understand ETFs and then they move on to these things. And these are really important things in your wealth creation. But in the next episode, Kate.
In the next episode, we're going to talk you through brokers. So that platform that allows you to buy and sell investments like shares and ETFs.
Because this is your gateway in.
This helps you take that first step into investing. And we might also talk about some micro investing apps that allow you to start with just $5.
Yeah. So if you're wanting to know, okay, Kate and Owen, this all sounds great. I want to be an investor. That is our goal by the end of this series, if you haven't already invested, to be invested. But if you're thinking, I like this idea, I want to get started now. How do I do it? That's the next episode. That's where we'll cover what a broker is and how to think about those, as well as link you to some resources to further explore those. So Kate, this was fun. Thanks for joining me.
Thanks for listening, everyone.